Good afternoon, everyone. My name is Patrick Gregory. I'm the Managing Director of the Cutler Center for Investments and Finance and the Director of the Babson College Fund, which is a two-semester program where a select group of students manage a portion of the college's endowment and are mentored by our executives and residents. I also sit on the Board of Trustees Investment Committee, which oversees the remainder of the endowment. Before joining the faculty at Babson, I was an institutional portfolio manager for many years. In my last post, I was responsible for the healthcare and TMT sectors of a $6 billion equity portfolio. This webinar is part of the Cutler Center's weekly series on the financial impact of COVID-19. Today, we're going to be discussing how the current pandemic is impacting the equity markets and how investors should think about finding opportunities and mitigating risk in these turbulent markets. The program is going to be divided into two sections. In the first, I'll be discussing the current state of the equity markets, the monetary and fiscal measures taken to mitigate the tail risk associated with the pandemic, and areas where investors are finding value in the market today. Then, John Baylor, who is a Senior Vice President and Senior Portfolio Manager for Magellan, will be joining me for a question and answer session. Throughout the presentation, the moderator will collect questions through the chat for response during the Q&A portion of the program. Before we start, I should also note that this webinar is being recorded and a copy of my presentation and the recording will be posted to the Cutler Center website later today. With that, let's get started. The equity market downturn during the first quarter was one of the quickest sell-offs in history and has resulted in wide price differentials between different stocks and sectors. This creates investment opportunities for active investors. For context, the US market fell by 33.9% in just 24 days, which was 10 times faster than in the 2008 correction. Global equity markets also plunged into bear market territory faster than ever before. The combination of a public health disaster, the ensuing macroeconomic shock, and an oil market crunch exacerbated by the Saudi-Russian price war inflicted a severe blow to stocks. In just 3 months, the outlook for equities has been transformed completely. When the year began, a thaw in the US-China trade war and recovering optimism over global macroeconomic growth set the stage for solid earnings growth in 2020. But within weeks, the novel coronavirus that surfaced in China spread across the world, throwing markets into disarray, with the S&P 500 falling 34% from its peak in February, as you can see here. In nearly every sector, small caps have underperformed their large cap counterparts. Overall, small caps, as measured by the S&P 600, were down 32.7% for the first quarter versus 19.6% for large caps. That's a meaningful difference by any account. So why did small caps underperform? Companies in the small cap category, which typically have market values of $2 billion or less, tend to be more sensitive to economic downturns than their larger peers. Explanations for this include that small cap companies tend to have much more leverage and less liquidity. As investors sell equities to raise cash in a sell-off, the price impact on stocks is generally commensurate with the stock's liquidity. So less liquid small cap stocks tend to see larger price declines regardless of their fundamentals. Leverage is the other factor impacting small cap performance. This chart shows the gap in leverage between small and large cap companies and the fact that it has been widening over the last 5 years as small companies took advantage of cheap debt to lever up. Given that small cap stocks are likely to take on additional debt in the near term while experiencing large negative earnings hits, this trend will likely be amplified. Dynamics such as these bifurcate the way companies are viewed by investors during a crisis. Value stocks also meaningfully underperformed growth during the sell-off. As you can see from this chart, the difference was relatively uniform across cap ranges. While not surprising, this dynamic was amplified by the fact that certain growth sectors, like tech, held up better given the nature of this particular crisis. This dynamic can be seen by looking at the relative performance of sectors in the current crisis versus prior crises as illustrated here. Obviously, biotech, food, and technology have held up much better than other sectors. Looking abroad, no market was spared. The MSCI World Index dropped 20% in the first quarter in local currency terms. At the sector level, energy stocks and financials were the hardest hit, just as in the United States. In many ways, this was the worst performance in years. It's important, however, to put these numbers in context. Taking a step back, while the decline was steep and quick, the broad market is down only 7% over the past 12 months, which is really remarkable. In addition, the market has retraced more than half of the losses from the February peak. Next, I'm going to talk a little bit about sell-offs to provide some historical perspective. A lot can be learned about how to invest during times of crisis by looking back through history. Provided here is a list of some of the headlines over the past 30 years. These include corporate accounting scandals, terrorist attacks, wars, and natural disasters. Despite these many crises, stocks have been a good place to invest, particularly for long-term investors. This slide shows how $1 has grown over that period of time, despite all the negative headlines. It's important to note that markets are always moving, whether they be up, down, or sideways. But the market is typically up 3 out of every 4 years. This chart illustrates the largest intra-year declines going back to 1980. Despite some notable drawdowns over the past 40 years, only 9 declines led to a down year. The challenge, of course, is not to let market declines get you off track. By withdrawing from the markets after a steep collapse, investors lock in losses and forfeit the chance of recouping those losses in an eventual recovery. An anecdotal example that I've shared with my students is that during 2008, I lost 40% in my personal account. I didn't sell any of my holdings, but I did selectively buy high-quality companies like Apple that were selling at fire sale prices. When I looked at my performance the next year, the portfolio had returned over 100%. Whereas during the same time, a lot of pension funds reduced their allocation to equities, thereby locking in losses and preventing any chance of recouping those losses in the bull market that persisted over the next 11 years. Moving in and out of the market to avoid volatility rarely works. It's like changing lanes while commuting to work. You don't get to work much faster, but you do significantly increase the chances of getting into an accident. As shown here, equities have provided positive long-term returns over all rolling 20-year periods. And importantly, setbacks have provided a good entry point for active investors. This chart reflects the VIX index, which is used to measure US equity market volatility. As you can see, volatility in March jumped up to levels not seen since the global financial crisis of 2008. This type of volatility creates investment opportunities for active investors because emotion, rather than fundamentals, are driving the buy and sell decisions. Take Boeing as an example. The company lost nearly 3/4 of its value in a month and then saw its share price almost double in a week. In a case like that, it's clear that the markets are not pricing securities based on long-term fundamentals. When share prices become disconnected from a company's underlying cash flows, opportunities are often created. Investors that have a dispassionate framework for analyzing probable outcomes can spot these types of opportunities. Here's a chart of the daily swings in the market over the last couple of weeks. Each of these pullbacks provided an opportunity to purchase or add to positions in high-quality companies. Unfortunately, many of us get concerned about how a trade will look in a month. While these trades might look foolish in a month, if the market sells off between now and then, investments in high quality companies trading at historically cheap valuations will likely look good 3 or 5 years down the road. There we go. Think about it this way. If it takes 3 years to recover to the market peak, then the average annual return over that period will be 7% as shown here. If the markets recover faster, say in 2 years, that implies a 15% average annual return. These are impressive returns, especially when compared to expectations for fixed income returns in this 0% interest rate environment. We've all heard the phrase buy low and sell high. Unfortunately, emotions, which is anxiety when the market declines or excitement when the market rallies, all too often cause investors to buy when prices are high and sell when prices are low. Poor market timing, selling to avoid declines, or buying after a rally can lessen your portfolio's long-term return. You can see that by looking at this chart, which shows the monthly flows of US stock mutual funds versus subsequent market performance. As you can see, equity flows follow equity returns, hurting long-term portfolio performance. Perhaps the best example of this is Peter Lynch's Magellan fund. Peter is considered to be one of the best investors of all time. His Magellan fund generated a 29% average annual return over his 13-year tenure. Despite delivering exceptional returns as a portfolio manager, however, the average investor in his fund actually lost money because they would consistently sell after a period of poor performance, selling low, and buy back into the fund after a period of strong performance, buying high. Not exactly a recipe for success. This dynamic isn't unique to Peter's fund. Market research shows that when investors try to protect their portfolios by moving in and out of the market, they instead limit gains and increase losses. As a result, the average investor underperforms over time. I wanted to talk a little bit about the policy response because I think that's going to help to shape the recovery that we're likely to see, not only in the economy, but in the financial markets. COVID-19 and the associated steps to contain its spread have caused the sharpest contraction in economic growth in history. In fact, the 11-year expansion that followed the global financial crisis rested on the back of the strength of robust consumer spending, but that central pillar of support has now been ripped from the economy. The impact on unemployment has been staggering. In just the first 2 weeks, 10 million people filed for unemployment claims in the United States, a number that hasn't been seen since the Great Depression. States like Ohio, Connecticut, and Nevada have reported claims that are 10 to 15 times the usual rate. In Las Vegas, as an example, 100,000 people who work on the Strip are now out of work. In aggregate, more than 10% of American workers have been displaced as a result of the pandemic. With a global economic recession now underway, the question is, how deep will it be and for how long? One indication is the speed and the size of the fiscal and monetary response of governments and central banks, which has been impressive. The intense response should limit the economic damage on the way down by preventing a widespread credit crunch. That said, economies cannot normalize and companies' earnings can't recover until the virus is brought under control and something approaching normal life resumes. Actions by the Federal Reserve and the Treasury during the global financial crisis, combined with those of other major governments and central banks, arrested the drop in global GDP to less than 1% between 2008 and 2009. From that experience, we can identify 3 necessary elements of what history might call the Bernanke-Geithner axiom of economic crisis management. Those are act fast, ensure that the central bank and treasury act in a coordinated manner, and finally, go big, with a solution that significantly exceeds the scale of the problem in order to be credible to market participants. When much of the global economy started to shut down and the specter of a depression as the worst case possible outcome emerged, the Fed applied the lessons learned from 2008 by going further and faster than ever before to remove the tail risk. The Fed acted quickly to push down rates to close to zero and made asset purchases that dwarfed those during the global financial crisis in just a matter of days. In addition, the $2.3 trillion fiscal package in the US amounted to 10% of GDP. The fiscal measures were even more prodigious in Germany, the UK, and France. Central banks signaled that they were willing to do whatever it takes to restore market stability, and that has certainly helped to reassure the jittery markets. I've provided a summary here of the Fed's efforts. In just 4 weeks, the Fed increased the size of its balance sheet from $4.1 to $5.2 trillion. The global financial crisis era special liquidity programs were restarted, and most importantly, the Fed has activated Section 13.3 of this charter, which allows the Fed to lend broadly to the economy by supporting short-term commercial debt. They also announced the CARES Act, and while these numbers are staggering, some will almost certainly be increased. Indeed, the political and monetary discussion has turned to the next set of stimuli, which are expected to be expansionary rather than protective, and designed to boost the economy once the lockdown period is over. So this brings me to the last section where I'd like to talk about investing amidst uncertainty. In this market, investors have 3 overarching concerns. Has the market reached a trough? How long will the recovery take? And what's the right way to allocate for uncertain times ahead? Definitive answers will be hard to come by until the pandemic peaks. However, by asking the right questions and drawing on lessons from past crises, we can prepare for the challenges ahead. The roadmap to recovery has 3 phases. Phase 1, which we're in now, is the slowing of the spread of COVID-19. Phase 2 will be a gradual reopening of the economy. And then the final phase will be relaxing of the controls completely once a vaccine is available. The question is the duration of each stage, which we don't have a clear picture of yet. As a result, markets are trading on new COVID-19 case data. This situation to me is analogous to investing in bank stocks through an economic cycle, where an increase in non-performing loans is tracked carefully. The market is forward-looking and does not buy on the change in non-performing loans, but rather on the rate of change, what we in finance call the first derivative. If the number of new cases is leveling out, the rate of change is trending toward 0, which becomes a positive sign for the future. The concern, of course, is a second wave of infection. Partly offsetting this concern are potential treatment options, where many investors are scrutinizing the 7 drugs that are currently being tested. The virus's evolution, the duration of social distancing policies, and the speed at which the macro policies gain traction will determine the ultimate shape of the recovery. If we experience a V-shaped recovery, the biggest losers on the way down will be the biggest winners on the way back up. If instead, finding a durable bottom in risk assets is a process rather than a distinct event, it's going to be harder to pick winners and we'll need to look sector by sector. In doing so, remember, the market is a discounting mechanism of known knowns and the weighted probability of many known unknowns. As an example, a known known is that economic data will almost certainly get worse from here. Another is that it's wise to avoid the epicenter of the crisis. After the dot-com bubble, for example, It took 15 years for tech stocks to revert back to their 2000 highs. We saw the same pattern with the financial crisis stocks, which were at the epicenter in 2008 and 2009. Two known unknowns are the pace of economic recovery and the path of post-recession earnings. Since the March lows, US equities have retraced over half their losses. Stated another way, in the face of the worst recession of our lifetime, equity valuations are down only to mid-2019 levels. That means that over the past few weeks, investors have increasingly assigned a higher probability to a shorter than anticipated recession and a stronger acceleration in profits. As an investor, you need to ask yourself if that's reasonable. Personally, I'm more skeptical. Another consideration is the valuation. The valuation for equities is below historical averages, though no longer at trough levels. Even so, equities do look attractively valued compared with bonds and other asset classes. After the sharp decline of government bond yields, the US 10-year is at 62 basis points. The global equity risk premium, on the other hand, was 7.1% at the end of the first quarter. That's a notable spread supporting investing in equities. The concern is that the forward estimates used in these price multiples isn't terribly reliable. The reason is that many companies have withdrawn forward guidance on earnings. So even though consensus estimates have come down, they likely don't reflect the full impact of the sharp recession at this point. In fact, earnings growth forecasts for 2021 versus last year's reported earnings are still positive, indicating that analysts are anchored to their old estimates, at least for now. Assessing the impact of a pandemic on earnings is certainly challenging. Longer-term investors will look across the valley and evaluate the current stock prices on their best estimate of 2022 sales and earnings. As an example, Home Depot is trading at 18 to 19 times 22 earnings. Long-term investors will then look at where the company has traded historically to get a sense of what investors have been willing to pay for the company. In the case of Home Depot, their current multiple is in line with their 5-year average. That said, I would note that you had the opportunity to buy this stock at as low as 14 times earnings in March during the sell-off. This idea of looking across the valley can also be used in discounted cash flow analysis. Provided here is a Dcf model for Microsoft that was published by Cowen and Company. As you can see, the analysts used 6 years of explicit forecast and then assumed a terminal growth rate of 3%. With a cost of capital of 8.5, the equity value per share was estimated to be $152 prior to the crisis. Since it's difficult to assess the impact the pandemic will have on near-term earnings and cash flows, let's take an extreme case and assume that the company generates no free cash flow in either 2020 or 2021. Believe it or not, our estimate of fair value would only change by $10 to $11. So when everyone else is paralyzed by fear and waiting for a better line of sight on near-term earnings, you can take a long-term perspective and buy high-quality companies trading at discounted prices. This same approach works very well during normal market environments for companies with binary risk. Say, for example, that you're invested in a pharmaceutical company that just announced disappointing study results. The stock is selling off precipitously on the news. If you know the net present value, or NPV, of each asset in the pipeline, you can simply deduct the per share value of the asset from yesterday's closing price to arrive at an adjusted price, assuming that asset is now worthless. If the stock is trading below that price, then the sell-off is creating a unique opportunity for you as an investor. It's important to note that downturns can have a Darwinian effect. When recession strikes, strong companies tend to get stronger, while weak companies get weaker or disappear. Take the retail sector as an example. As demand dries up, several weaker retail chains probably won't make it far into 2021. While that's unfortunate for their employees and shareholders, their revenue will go to the survivors. So as you survey the market, the first order of business is to determine which companies have the staying power to ride out this downturn. This involves taking a close look at a company's underlying business demand, financial position, and their ability to cut costs. When assessing which companies will manage the crisis successfully, your analysis should be both cash flow and scenario based. By building models of monthly cash burn under various scenarios, you can look and see how the company would perform if we have a sharp V-shaped recovery versus a U-shaped one. In a U-shaped recovery, short-term demand also drops precipitously, but the pickup is much slower due to lower personal income, damaged consumer balance sheets, and a loss in consumer confidence. These patterns might also unfold in multiple phases given the nature of the crisis. This is already playing out in Hong Kong, Taiwan, and Singapore, which had some success in containing the virus, but are now experiencing a second wave of infections and, as a result, lockdowns. While none of us know the path of the virus or the length of the recession, one thing is clear. Many companies are going to need to raise cash to ensure survival. Here, I detail some of the means companies will use to close the critical funding gaps. They include reducing labor and R&D expenses, asset sales, and the acceptance of government aid. Unfortunately, many of these paths come at the expense of future growth potential, and for that reason, must be considered carefully. Next, we need to evaluate the liquidity and the solvency of these companies. Liquidity is a short-term concept referring to the ability of the company to pay off short-term liabilities with current assets. Solvency, on the other hand, is the ability of a company to meet its long-term debt and financial obligations. Solvency is essential to staying in business and requires reviewing both the company's debt schedules and the debt covenants. After you've screened for balance sheet weakness, your fundamental research can focus on the underlying business. This requires looking through the current uncertainty and projecting ahead to 2022 under different global recovery scenarios to put current prices in context. In the process, you'll want to look for companies that have a moat around their business. That might be a license that nobody else can get, or a regulatory advantage of some kind. These competitive advantages will allow the company to not only survive, but to thrive when the economy recovers. Investors should also think about what types of trends will reshape the landscape in the future and which companies are in the best position to benefit from those secular trends. I've listed 4 interesting themes here, starting with digital transformation, which was a top corporate priority before the crisis and will emerge as an even stronger one. Digital transformation includes cloud infrastructure as well as e-commerce companies. Healthcare is also interesting. In fact, there is something to like here regardless of your investing style. For value investors, so-called elective procedures such as joint replacements and cosmetic surgery will resume, providing opportunities in oversold medical technologies. For growth investors, biotech and laboratory research companies should benefit from increased spending directed to new areas of research and development. By contrast, the recession will deal a critical blow to the marginal players in the consumer sector, given that it's at the epicenter of this crisis. But it's important to note that durable IP and brand power should allow some storied companies to prosper. For example, after being cooped up at home for weeks on end, many homeowners may decide that there are things that they want to upgrade, which could trigger a surge in business for home improvement retailers like Home Depot and Lowe's. Finally, The digitization of money was already happening, but will now accelerate due to the crisis. This trend will continue to support fintech companies like Square. As you assess these and other investment opportunities, think about what life will be like after the pandemic. People around the globe are experiencing startling changes in everyday life. This could lead to changing consumer demand going forward. For instance, will companies and their employees be more comfortable with remote working arrangements and in turn permanently reduce demand for big city office space? What about grocery shopping? For many, the biggest hurdle to online grocery shopping is getting comfortable with placing the first couple of orders. Now that millions of people have been forced to shop for food online, will they continue to do so after sheltering in place? Answering these types of questions can help identify the companies that will benefit or be hurt by changes in consumer demand. As you're evaluating the investment landscape, you should also consider ESG factors as part of your investment process. MSCI research indicates that these companies are more profitable, have less volatile earnings, and are better at mitigating serious business risk. These attributes were in high demand during the recent sell-off. That explains why companies with the highest ESG ratings fell by only 10.8% in Q1, when the market tumbled by 19.6%, as you can see here. S&P Global Market Intelligence analyzed 17 exchange-traded and mutual funds with more than $250 million in assets under management that select stocks based in part on ESG criteria. Interestingly, of those funds, 12 lost less value this year than the S&P 500. The top performer in the analysis was Brown Advisory's Sustainable Growth Fund, which fell by only 5.4% as of April 9th, compared to the market, which was down 13.7% over the same period. Karina Funk is the manager of Brown Advisory's Sustainable Growth Fund, which holds 34 positions, including Microsoft, American Tower, and Amazon. Recently, she characterized ESG as a means of turning over more rocks, looking at more information, and adding a complementary lens in order to gain conviction on a company's strategy, operations, and growth prospects. To me, this is just a means of doing a more complete fundamental analysis of a company. During this period of unprecedented upheaval, some management's most enduring actions will include ESG decisions in addition to financial ones. Home Depot, for example, recently froze prices on goods deemed to be in high demand during the current health crisis. The company also extended extra paid leave to employees over age 65 who are most at risk for getting sick from the coronavirus. PayPal established an emergency relief fund for their employees who had short-term cash needs. And Microsoft is giving its collaboration software to nonprofit organizations for 6 months for free. Investors are starting to embrace these types of corporate actions, even though they may come at the expense of short-term earnings. In conclusion, I'd like to reiterate that investors with a long-term view and a focus on stock selection can find abundant investment opportunities during troubled times. This chart shows the return dispersion of stocks held for various time periods ranging from 1 day to 5 years. There is a greater return dispersion between the 10th and the 90th percentiles as the holding period is extended, supporting the view that there are more opportunities for differentiated performance when you hold securities for 3 to 5 years. Despite that fact, the average holding period for a New York Stock Exchange security is less than a year. With such a short holding period, stocks oftentimes sell off because investors focus on the short-term outlook, even though the long-term fundamentals remain intact. This creates a buying opportunity for disciplined investors. In industry parlance, we call this time arbitrage. which should be a cornerstone of a disciplined investment process for individuals. After all, investors who focus on sustainable cash flows and express their differentiated views on the fundamentals of the business in their stock selection decisions will have a better chance of outperforming the market. As Kent Hargis, who's the Chief Investment Officer at AllianceBernstein notes, creative thinking, a sober assessment of short-term challenges, and importantly, a focus on long-term business fundamentals and valuation are key to identifying the quality companies poised to survive the pandemic and thrive in the new post-crisis reality. With that, I'll now move to the Q&A session of the webinar. Before starting the Q&A, however, I did want to introduce our special guest for today. John Baylor is the lead portfolio manager for the dividend-focused large cap value strategies at Magellan. He has managed the team's dividend strategy since 2005 and is a lead portfolio manager for the equity income strategy, which emphasizes dividend growth stocks. He is also a senior research analyst on the dynamic large cap value strategy, where he's responsible for the consumer, technology, and communication services sector. John also serves as the chairman of the Cutler Center Advisory Board and has graciously agreed to take questions and give his perspective on the current state of the markets. Welcome, John.
Thanks, Patrick.
So Leslie, are we ready for the Q&A?
We are, yes. So thank you, Patrick, for that great presentation. And thank you, John, for joining us today. We do have a question from Zach that is specific to slide 41, where you discussed looking across the valley and focusing on 2021, 2022 estimates. Mm-hmm. Do you think that may be a result of analysts not having data points because so many companies have pulled their 2020 guidance?
Yes, absolutely. So what's interesting is that consensus estimates today certainly don't reflect the reality of the current economic situation. And that's in part because oftentimes sell-side analysts are going to take their cues from management, and with management pulling much of their guidance on their Q1 call, they don't have much to key off of. And so I think some of those numbers are really stale. But if investors are able to look across the valley and to really focus on what might be a reasonable estimate for sales and earnings starting in 2022 or 2023 and put a multiple on that, I think that you have a much better perspective than being too short-term focused and looking at what's likely to happen over the next 6 to 12 months, which I think for many companies is going to be quite dire.
Other questions from participants? John, it'd be great to hear from you. Are there any particular valuation metrics that you tend to look at and that you might be looking for opportunities today in this market?
Yeah, great. Thanks, Leslie. And, I know there's been a lot of comments saying how great a presentation Patrick has done. And I just echo that. This is a real thought leadership. All these Finance Fridays, I've listened to all of them, and they've been excellent, everyone, and including this one. So really appreciate everyone doing this, for BAPS. And so, some of the I'm a value manager by training, and so I spend a lot of time thinking about valuation. I'm a big fan of thinking about intrinsic value. You've probably heard Warren Buffett talk about intrinsic value, Benjamin Graham talk about intrinsic value. And it really gets back to what Patrick was talking about on these long-term DCF cash flows. And in any valuation metric, let's say a PE, price to book, all that is a representation of a long-term cash flow model. And so at the end of the day, even though you don't know all the factors that go into the discounted cash flow model. It's going to be very difficult to predict exactly what the cash flows are going to be out, for any length of time. It's going to be difficult to say what the discount rate is. You use your CAPM model, do a weighted average cost of capital, but it's the only thing that we really have that I think really represents the intrinsic value of a company. So you have to do your best. So at the end of the day, I think it's all about that long-term discounted cash flow model. And then you can back into, any metric that you want to look at, price to earnings, price to sales, banks, I use price to book, I use enterprise value EBITDA for some of the more, cash flow oriented companies. But at the end of the day, it's just a representation of a long-term cash flow model.
Great, that's helpful. We have a question from Ben. He wants to know, what do you think is the best way to go about answering these uncertain questions? Like, how will consumers' taste change as a result of what's going on today?
Do you want to take that, John, or you'd like me to?
Oh, I thought it was to you.
Oh, sorry. So, so I think that there are a number of different ways that we can do it. Personally, I think that it's going to be important that you not just focus on financial or economic data, but rather that you broaden your scope and look at, as an example, credit card information or traffic data or even satellite data in order to try to better understand what's going on today and then look at the rate of change over time. And that's going to help. I also think that primary research is a critical tool. One of the things that we always talk about in BCF is the fact that if we're going to try to outperform the markets, we need to have a differentiated viewpoint. And oftentimes that comes by having some form of an edge through primary research. And so it's not just using these different resources that we have at our disposal. And certainly we have a number through the Cutler Center, but it's also actually getting out there and doing the primary research to make sure that we understand how some of these consumer trends are changing. I guess in summary, I would say don't limit yourself to the traditional metrics, whether they be economic or financial. Look at any data that you have access to. And when you've sort of extinguished that, then start with your primary research.
Okay, great. Another question around valuations. So how do you view valuations where the DCF enterprise value is 90% plus terminal value and 10% for free cash flow, especially for companies who might be gearing up for bottom line profitability in the next few years? Zach specifically mentioned that he sees this a lot in the biotech space.
Yeah, I can take that. So it's tough for me as a value investor to have a lot of confidence, in long-term DCF cash flows where, much of the valuation is in the terminal value. That clearly has not been the right strategy in the last 10 years because you could have bought, one of these FANG stocks and the current cash flows didn't look great, but over the next 10 years, let's say you bought these, stocks in 2010, they turned out to be worth a lot more money than a lot of us thought they would have been. So I'm inclined to be looking at the companies that have a lot of cash flow currently, and the simple reason for that, and the simple reason I'm a value investor, is because I think it's very difficult to predict the future. And so a lot of those growth stocks that you think are doing really well and will continue to do really well, things change. And, there might be competition, which probably is going to be the case, especially if you have high growth rates in that business. If it's a high return on invested capital type of business, maybe the barriers to entry, are not as high as you predicted. And so those cash flows aren't going to come to fruition the way you think they might be. Where when you're buying value stocks and you're buying stocks that are very cheap on current cash flow or historical cash flow, and you feel like you've got a lot of confidence in the next couple of years on those cash flow, I just think that's a better bet. And I get it, it hasn't been a strategy that's worked recently. There's a lot of great biotech companies where all that cash flow is, in the terminal value. And if you think you have an edge, on one of those drugs hitting, that's the primary research you have to do and have a lot of confidence in that those cash flows will pay off over time. It's just been my experience that, you're better off buying current cash flows versus, cash flows that are way, way in the future.
With all of these QE and fiscal stimulus from the Fed, and with interest rates at all-time lows, will this push multiples, in your opinion, PE, enterprise value to EBITDA, to all-time highs, even post-crisis?
Yeah, so there's no doubt. It's if you agree that everybody's doing long-term cash flows, the discount rates have come down. With interest rates moving lower. So there is a good argument to be made that valuation should be higher in this low income or low interest rate world. I would also say Jason Trennert over at Strategis coined this term TINA, which is, there's no alternative for equities. And what he's saying is, because interest rates are so low, because spreads are so low on corporate bonds currently, you can't find income, you can't find good returns anywhere else other than the stock market. So it's pushed people into the stock market and raised the valuation. So I think there's two reasons that you could argue that valuation should be higher than historical. One, because rates are so low, you can discount those cash flows back and you get a higher multiple on an enterprise value or market cap basis. And then two, you have to buy equities because you're not getting income anywhere else in the world.
We have another question here from Jerome. What are your thoughts on ESG? What are the trends you're seeing? And in particular, it seems a distinction between E, S, and G is necessary.
Yeah, so, I like that, view that Patrick had and showed, how well the ESG funds have done. I think ESG is very synonymous with low beta and low volatility, less economic sensitivity. So that's why a lot of those ESG funds have done well in this downturn. I do think that, coming out of this downturn, maybe they won't do as well because the characteristics that they have, which are very, high quality, and coming out of a downturn, you don't necessarily want to buy high quality. You want to buy more beta, more cyclicality. So I think that's probably why ESG has done well in the short term. I actually took on a new role recently as the chairman of our proxy and governance committee at Magellan, and I really have gained a greater appreciation, especially for the G on ESG, really understanding the compensation trends that are going on with management teams. How are they incentivized in terms of making numbers? Is it a TSR, total shareholder return basis? Is it just based on hitting a certain earnings growth threshold? It's really good to understand that for companies because management teams are going to be incentivized to do how they're going to get paid. So I do think G in my world is very important. I think it's been very helpful. In terms of the E and the S, we're spending a lot more time at Magellan, really considering the social impact that companies have. And the environmental impact. But I think you have to take a step back and you have to say, are those going to be impactful to long-term shareholder returns? And in some businesses, that will be the case, and you have to consider it. In other businesses, that's not necessarily the case. So, we really have to take it on a case-by-case basis. But I am a big believer that that if a company is looking after all their stakeholders, the shareholders, their employees, the communities they're working in, the best ones tend to look at all that. They tend to take a long-term view. Patrick talked about how important it is to take a long-term view in investing. I think it's important as a CEO to take a long-term view. And if you take a long-term view and you're not looking just to make that dollar over the next quarter by, cutting expenses, you're going to treat all your stakeholders well, and those are the businesses that we want to invest in because I think those are the ones that are going to have the best shareholder returns eventually if they're treating all their stakeholders well for the long term.
If I could just add to that, I do think that the G component is the one that we tend to focus most on. And what's interesting in today's markets is we're getting a lot more information on that component, because I think it's easy for companies to put out a nice shiny sustainability report, but now we're really getting to see how they're treating various stakeholder groups, whether it be their employees, whether it be their customers or others. And I think that those actions that they take today will really help to shape not just what their ratings will be in the future, but how investors think about them, whether they be retail or institutional investors. And so it's an interesting time to be focusing on those factors and getting that data in real time.
Great, thank you. On the topic of ESG and along the lines of some of these factors that both of you discussed, do you have any insight on what allowed Brown Advisory's U.S. Sustainable Growth Fund to outperform comparable ESG funds?
So I don't know if you do, John.
I don't.
So Karina is, so I'll make a shameless plug that Karina is going to be one of our speakers for an upcoming ESG panel that we're doing. I would say that she is probably one of the most well-respected managers in that space that I have met. And one of the things that I think she does very well is that she sticks to her circle of competence, and she has a relatively concentrated portfolio of typically 30 to 35 names. And so I think that she knows those companies very well and has her hand on the pulse of how they're going to respond, certainly during crises like we see today, but also how they're going to perform over the longer term. And so I think those are some of the reasons that that she's had such strong performance. But I too look forward to asking some additional questions and hopefully learning more about what she's doing when she comes to campus next year.
Yeah, that'll be great. We've seen a huge spread widening in fixed income, which has created many interesting opportunities. Do you think that a balanced 60-40 portfolio is still the most optimal mix?
So, hey, I love the 60-40 portfolio. If you look at the 60-40 mix over the last 10 years, versus a lot of the hedge funds that, suggested that they could outperform, a 60-40 mix at much higher fees than you would be paying if you just bought an index fund and a bond fund. It's done incredibly well. And so I think the 60-40 mix makes a lot of sense. At the end of the day, clearly every investor, every client is going to have a mix that suits them. I mean, if you've got a lot of expenses that are coming due, in the short term, you probably don't want a 60-40 mix. You want something that's a lot higher. You want, a decent amount in cash to pay for those expenses. But if you're a retirement plan that has a very long time horizon, I think a 60-40 mix makes sense. And I think at this point, it might even be higher. It might make sense with more equities. Like I said, with this TINA, I think you're going to earn a very low return. I mean, the spreads widened very short term in high yield and corporate. But now that the Federal Reserve is going in and buying a lot of ETFs, buying a lot of bonds, those spreads, especially on the investment grade side, have narrowed a lot. So, I don't think there's a whole lot of attractiveness in investment grade. There might be some interesting ideas, within the high yield, but at the end of the day, I do think, longer term, it makes sense. The 60-40 mix does make sense.
I would just say that it's always good to start with a breakdown along those lines, but then you really do dig into John's point and look at the two key drivers are going to be any liquidity needs and the time horizon of the individual, and that will help to shade those figures, as will your capital market expectations. But certainly a good starting point, particularly for older investors.
Mm-hmm. Isabel here has a question. Patrick, you discussed how many investors are moving in and out of the market at the wrong time, selling at the low and buying at the high. John, have you noticed this trend with your clients, and how do you manage communication with your investors during these times of high volatility?
Yeah, that's a great question. So, the key is being very clear ahead of time with your clients when you're talking to them, when they're investing with you. I think that's a big issue that a lot of investment managers have. They promise something and then they don't deliver. So what we've done over the last since I've been running the dividend portfolios at our firm, it's been very clear. We have characteristics that are high dividend yield and value. And so, when those are out of favor, we tend to underperform, and we're going through a period where, we're having a tough time. And the key is being really upfront with your clients and meeting them during these tough periods and talking about, what's going right and what's going wrong in your portfolio. And the clients really appreciate that. They appreciate that you're willing to go and talk to them about your investment strategy and what's working and what's not working. So constant communication, I think, is the key to continue during these tough times. But the other point that I made was I really think you need to set expectations correctly ahead of time, so nobody's surprised when the market reacts a certain way and your fund is doing different than what you would expect. So I've been pleasantly surprised with our interactions with clients. They've been very supportive.
Great, good to hear. I think that covers the questions that have come in through the chat, unless there are any others from participants. If not, I want to thank you both. Thank you, Patrick and John. This was a great presentation. Very, very helpful insights into today's market environment.
Thank you.
Great. Thanks a lot, Leslie.
Thank you.
Thank you, everyone, for joining.